China has stopped selling silver to the West, not slowed, not reduced, stopped. And I want to be precise about what that word means in the context of the global silver supply chain before we go any further, because the mainstream financial press has either missed this story entirely or is describing it in language that completely obscures its significance. China is the world's largest silver refining nation, not the largest miner, that is Mexico, the largest refiner. The country that takes raw silver ore and silver-bearing concentrates from mines globally, processes them into deliverable silver bars, and historically exported a meaningful portion of that refined silver to Western markets, to COMEX warehouses, to London bullion market vaults, to Swiss refiners, and to industrial consumers across Europe and North America. That flow has stopped. The export licenses, the customs approvals, the logistics arrangements that moved Chinese refined silver into Western supply chains, they are not operating at the same level they were 90 days ago. And the 48-hour window I referenced in the title is not a dramatic flourish. It is a specific, measurable time horizon tied to a COMEX delivery obligation that comes due the day after tomorrow, against a registered inventory that has been declining for months and that can no longer count on Chinese refined silver as a replenishment source. I'm going to show you today exactly what happened with Chinese silver exports, when it started, what is driving it, what the COMEX delivery mechanics look like in the next 48 hours against the inventory that remains, what the gold market is confirming about the macro environment behind this decision, and what you need to do about your positioning in both metals before that 48-hour window closes. This is not a story that is going to wait for you to process it at a comfortable pace. Let us go through every piece of it right now. Let me give you the documented timeline, because the story has been building for longer than most people realize, which makes the current acceleration more significant, not less. Approximately 14 months ago, China's Ministry of Industry and Information Technology published a revised classification of silver as a critical industrial material under China's Strategic Mineral Resources Management Framework. This reclassification was largely ignored by Western precious metals analysis at the time. It received brief mention in commodity trade publications and then disappeared from the mainstream conversation. But what that reclassification did, in practice, was create the regulatory foundation for restricting silver exports without requiring a formal export ban announcement. By defining silver as a critical industrial resource, China gave its regulatory agencies the authority to prioritize domestic consumption over export at any time they deem domestic supply to be under pressure. 8 months ago, the practical effect of that reclassification began to show up in trade data. Chinese silver export volumes, which had been running at approximately 120 to 140 metric tons per month to Western markets, began declining. The decline was gradual enough in the first 4 months to be attributable to normal seasonal variation. Western traders and analysts noted slightly tighter silver availability from Asian sources, but attributed it to logistics and post-holiday slowdowns. It did not generate headlines. 4 months ago, the decline in Chinese silver export volumes to Western markets became impossible to explain through seasonal variation. Monthly export figures dropped to approximately 60 to 70 metric tons, roughly half of the prior run rate. COMEX warehouse keepers, who had been receiving regular shipments from Chinese refiners, began reporting gaps in expected delivery schedules. The registered silver inventory, which had been declining for other structural reasons related to industrial demand, began declining faster because one of its primary replenishment sources was no longer operating at full capacity. In the past 30 days, Chinese silver export data from customs filings shows that outbound silver shipments to Western markets fell to approximately 18 to 22 metric tons, less than 15% of the historical run rate. This is not a reduction, this is a functional cessation. The pipeline that has historically moved Chinese refined silver into Western supply chains has gone from full flow to near zero in 14 months, with the final acceleration happening in the past 4 weeks. The stated reason from Chinese regulatory communications is domestic demand prioritization. China's solar manufacturing sector, which is producing approximately 80% of the world's solar panels, is consuming silver at a pace that has made domestic refined silver supply a strategic priority. The Chinese government has made a policy decision that Chinese silver stays in China to serve Chinese industrial production targets before any surplus is made available for export. This is not a temporary decision driven by a short-term logistics issue. It is a strategic policy decision backed by a regulatory framework that was constructed 14 months ago specifically to enable this outcome. The supply of Chinese refined silver to Western markets is not going to normalize in a week or a month. It is going to normalize, if it normalizes at all, when China's domestic solar and industrial silver demand is fully met, which, given the scale of China's solar manufacturing build-out, is not a near-term prospect. Let me now show you the COMEX inventory picture and explain precisely why the 48-hour window matters. COMEX registered silver, the silver that is specifically designated for delivery against futures contracts, not simply held in approved warehouses, currently stands at approximately 68.4 million troy ounces. This number has been declining for an extended period. At its recent peak, registered silver was above 150 million ounces. The decline from 150 million to 68.4 million represents a 54% drawdown in the physical silver that is available to fulfill delivery obligations against paper contracts. The open interest in the current active silver futures delivery month represents a notional claim on approximately 485 million troy ounces of silver. The ratio of paper claims to registered deliverable silver is therefore approximately 7.09 to 1. For every 1 ounce of silver sitting in COMEX registered vaults with a delivery designation, there are 7 paper claims outstanding that could theoretically demand delivery of that ounce. Under normal market functioning, the vast majority of those paper claims are rolled forward or cash settled before delivery month arrives. The assumption embedded in COMEX market structure is that physical delivery will be demanded by only a small fraction of open interest. That assumption is held for decades, and it holds in most delivery months without incident. But the assumption depends on 2 things being true simultaneously. First, that holders of long contracts prefer to roll or cash settle rather than stand for physical delivery. Second, that the registered inventory is sufficient to handle whatever percentage of longs do demand physical delivery, plus a safety buffer. The 48-hour window is this. The first notice day, the day on which the exchange can begin notifying long holders that they have been assigned for delivery, arrives in 48 hours. In the period immediately before first notice day, long holders who do not want physical delivery exit their positions. Long holders who intend to stand for delivery hold through first notice day and accept their delivery assignments. The question that matters for the next 48 hours is, what percentage of the current open interest will stand for delivery? And the answer to that question, against the registered inventory of 68.4 million ounces that can no longer count on Chinese refined silver as a replenishment source, determines whether this delivery month proceeds normally or becomes a visible market stress event. Here is the specific arithmetic. If 15% of open interest stands for delivery, a historically elevated but not unprecedented fraction, the delivery demand is approximately 72.75 million troy ounces. The registered inventory available to meet that demand is 68.4 million troy ounces. The delivery demand exceeds registered inventory by approximately 4.35 million troy ounces. The market must source that physical silver from outside the registered vault system, at whatever price it takes to attract that silver into registered status in the delivery window. 14 months ago, one of the primary sources for replenishing COMEX registered silver when delivery demand was high was Chinese refined silver flowing through the normal export channels. That source is now operating at less than 15% of its prior capacity. The safety valve that has historically provided inventory relief in tight delivery months is no longer functioning. The 48-hour window is not certain to produce a delivery failure. Eligible silver can be converted to registered. Other physical sources can be mobilized. Longs can be induced to roll with cash incentives. But each of these resolution mechanisms has a price cost. Converting eligible to registered requires the holder's consent and typically a payment. Cash-inducing longs to roll is effectively paying a premium over the paper price to avoid physical delivery, which is itself a form of price discovery. The resolution of the delivery month, whatever form it takes, has a cost that accrues to the short side and benefits the long physical holders. Now let me show you what the gold market is telling us about the macro environment that is driving China's silver export decision, because understanding the gold signal is essential for understanding the full scope of what is happening. Gold is currently at $4,726. It has been making consistent new highs. The gold-silver ratio is at 61.4 to 1 and has been compressing for 8 consecutive weeks. Both of these gold market behaviors are confirming a specific macro thesis. Global monetary system stress is real, it is building, and it is driving capital toward physical assets at a pace that is accelerating. China's decision to retain its silver domestically is not made in isolation from the same macro environment that is driving gold's price appreciation. The Chinese government's strategic calculus in retaining silver domestically reflects an assessment that in a world of increasing monetary system stress, strategic industrial materials, including silver, are more valuable kept within China's sovereign control than exported for foreign currency that is itself subject to monetary system risk. China has been buying gold at the sovereign level simultaneously. The People's Bank of China has added to its gold reserves in every month for which data is available over the past 2 years. The same institutional impulse, accumulate physical, monetary, and strategic materials, reduce exposure to dollar-denominated paper claims, is driving both the gold buying and the silver export restriction. These are two expressions of the same strategic policy. For silver specifically, the Chinese retention decision reflects something that Western analysis has been slow to recognize. China's industrial planners have done the same solar demand math that the Silver Institute published. They understand that 232 million troy ounces of annual silver demand from their own solar manufacturing sector alone is a number that creates domestic supply pressure. They have decided, rationally from their policy perspective, that the silver their refineries produce should serve Chinese industrial production targets first and Western market replenishment needs second, or not at all. The gold market, in pricing $4,726 gold with consistent new highs and compressing gold-silver ratio, is reflecting the aggregate assessment of global institutional capital that the macro environment that is driving China's silver decision is real and sustained, not temporary. Gold does not make consistent new highs against a backdrop of improving monetary system stability. Gold makes consistent new highs when the institutional consensus is that monetary system stress is increasing. And increasing monetary system stress is exactly the environment in which China's strategic decision to retain silver domestically makes its most rational geopolitical sense. Gold at $4,726 is not just a precious metals market data point. It is a geopolitical signal that the fracturing of the global monetary and trade system is advanced enough that sovereign actors are making resource retention decisions. The silver export cessation is one manifestation of that fracturing. It will not be the last. Let me take you beyond the COMEX delivery mechanics to the broader supply chain impact of China's silver export decision, because the COMEX is the most visible and most immediate stress point, but it is not the only one. European industrial silver consumers, manufacturers of solar cells, electronics components, medical devices, and automotive systems, have historically sourced a portion of their silver through Swiss and London market intermediaries, who in turn sourced from Chinese refiners. That supply chain is now disrupted. European manufacturers who placed orders with intermediaries expecting delivery of Chinese refined silver in the coming weeks are receiving notifications that the supply is not available at contracted delivery timelines. The practical effect for European manufacturers is that they are now competing for silver from alternative sources, primarily South American and Australian mine production, Peruvian and Chilean concentrate refining, and Mexican smelter output that was previously allocated to other buyers. This competition for alternative supply is pushing physical premiums in European markets above their historical ranges. European dealers who normally charge a few percent above spot for silver bars are reporting premiums of 8 to 12% above spot as immediate physical availability tightens. This European premium expansion mirrors the Shanghai premium that has been running at $10 to $12 above COMEX for weeks. Two different geographic markets, Shanghai and Europe, are simultaneously pricing physical silver at a significant premium above the COMEX paper price. When two major physical markets on opposite sides of the world are independently pricing a commodity above the primary paper market reference price, the paper market's ability to function as an accurate price discovery mechanism is fundamentally compromised. The COMEX paper price is becoming an outlier relative to global physical market reality, not the reference that other markets price off of. The London Bullion Market Association data, which tracks physical silver lending rates and lease rates in the over-the-counter market, is showing silver lease rates moving in the same direction as gold lease rates, upward, at a pace that signals tightening physical availability in the OTC market that underpins the formal exchange market. Lease rates rising means that borrowing physical silver for delivery purposes is becoming more expensive because the supply of lendable silver is declining. Chinese refined silver was a significant component of the silver that flowed through the London lending market. that flow has been substantially reduced. The combined picture: COMEX registered inventory at 54% below peak with delivery month approaching, European physical premiums at 8 to 12% above spot, Shanghai physical premium at 10 to 12 above COMEX, London lease rates rising, and Chinese refined silver supply at 15% of its prior run rate, is the most comprehensive physical silver supply stress picture that has existed in this market since the 2011 period. And unlike the 2011 period, the current stress is being generated by a structural supply disruption, China's policy decision, rather than by a demand spike alone. Structural supply disruptions are slower to resolve than demand spikes and produce more sustained price effects. Let me address the 48-hour window with specific and direct guidance on positioning, because this is not a situation where abstract strategic thinking is sufficient. The 48-hour window is real, it is specific, and it requires a specific response framework. The first thing to understand is that the 48 hours before first notice day is the period of maximum uncertainty. It is the period in which the paper market is most volatile because participants are repositioning ahead of delivery month. Longs who do not want delivery are exiting, longs who want delivery are holding, shorts are managing their delivery obligations. The paper price during the 48-hour window can move in ways that feel counterintuitive. It can drop temporarily as non-delivery longs exit their positions, even though the underlying physical stress is at its most acute. A temporary paper price drop in the next 48 hours is not a signal that the physical stress thesis is wrong. It is the mechanical noise of pre-delivery month positioning. For physical silver holders, the 48-hour window changes nothing about your strategic position. Physical silver held outside the paper market system is not affected by COMEX delivery mechanics. You own the metal. The stress in the delivery system is, if anything, confirming the thesis that led to your physical position. Hold. The delivery month outcome will either produce a visible stress event that confirms the thesis dramatically, or produce a resolution through premium payments and eligible to registered conversion that confirms the thesis more quietly. Either outcome validates the physical position. For investors considering adding to physical silver positions, the 48-hour window is not the optimal moment to add physical silver because dealer premiums are likely to widen during delivery stress. The optimal window for additions was the weeks leading into the delivery month. If you have not yet built your position, the delivery month outcome, whichever direction it takes, will provide a clearer subsequent entry point. If the delivery stress produces a price spike, wait for the initial volatility to settle. If the delivery resolves with premiums and eligible conversion and the paper price dips, that dip is the entry point. For investors in silver mining equities, the 48-hour window creates short-term equity volatility that has no relationship to the fundamental earnings power of the mining companies you hold. A paper price dip in the pre-first notice day window does not change the all-in sustaining cost, the reserve base, or the multi-year production plan of a quality senior silver producer. The equity volatility is noise. The fundamental thesis that senior silver producers are generating extraordinary free cash flow at $77 silver and that their margins expand dramatically in a structural silver price appreciation is intact regardless of 48-hour paper market mechanics. For gold holders, gold's role in the current episode is as the macro confirmation signal. Chinese silver export cessation is a supply shock. Gold's consistent new highs are the monetary system stress signal. Both are pointing in the same direction. Gold at $4,726 is telling you that the macro environment that made China's silver retention decision strategically logical is not going away. Hold your gold position through the COMEX delivery month mechanics. The delivery outcome does not change the gold macro thesis. It either accelerates it or extends the timeline to the same destination. The strategic principle across all positioning categories is this: the 48-hour window is a short-term mechanical event inside a long-term structural story. Do not let the short-term mechanical noise drive long-term strategic decisions. The story of China stopping silver exports to the West is a structural story measured in months and years, not in hours and days. The 48-hour window is where the story becomes most visible in the short term. It is not where the story ends. The summary of today: China stopped selling silver to the West. The timeline: reclassification of silver as a critical industrial resource 14 months ago, export volume declining to 50% of normal 8 months ago, now operating at less than 15% of its historical run rate. The driver is China's domestic solar manufacturing sector, consuming silver at a pace that has made domestic supply a sovereign strategic priority. This is a structural policy decision, not a logistics disruption. The COMEX impact. Registered silver at 68.4 million troy ounces, 54% below peak, with a 7.09 to 1 paper to physical ratio entering a delivery month in 48 hours. The Chinese refined silver that historically replenished registered inventory in tight delivery months is no longer available. If 15% of open interest stands for delivery, demand exceeds registered supply by 4.35 million troy ounces. Resolution requires price payments to attract alternative supply. The broader supply chain. European physical premiums at 8 to 12% above spot, Shanghai premium at 10 to 12 above COMEX, London lease rates rising. Three major physical markets simultaneously pricing silver above the COMEX paper reference price, the most comprehensive physical stress picture since 2011. Gold at $4,726 is confirming the macro environment that makes China's decisions strategically logical. Monetary system fracturing is the context. Silver supply retention is one expression of it. Gold's consistent new highs are the institutional capital's aggregate assessment that the fracturing is sustained. Positioning for the 48-hour window. Physical holders hold, potential buyers wait for delivery outcome clarity, equity holders manage through the volatility without changing strategic position, gold holders recognize the macro confirmation signal and maintain exposure. The 48-hour window is not the story. It is the chapter in a structural story that is measured in months and years. Be positioned for the full story, not just the chapter. Subscribe to this channel right now. The delivery month outcome is going to be one of the most watched events in the silver market this year, and this channel is going to cover every development as it happens with exactly the level of depth and precision you receive today. Share this video with one person in your network who holds silver and has not yet heard about China's export decision. They need to see this analysis before the 48-hour window closes. And comment below, did you know about China's silver export reduction before this video? Tell me what it changes about your positioning and what you are watching in the next 48 hours. I read every single comment and I want your analysis.